Welcome to Dania Accounting. My name is Ida. In today's video, we will discuss why a shareholder loan in Denmark is a really bad idea. So, what are shareholder loans? Shareholder loans can be anything from payments that are done using the company credit card to pay for a private cost on behalf of a shareholder, salary advances paid to a shareholder when a payslip has not yet been made, dividends that are distributed without complying with the Companies Act, or actual loans issued to the shareholder. How are shareholder loans regulated in Denmark? When preparing the accounting or annual report, then sometimes accountants find loans to the shareholder. Shareholder loans can be very complicated to handle, since Denmark has two different sets of legislation. First, let's discuss the Companies Act. In Denmark, a shareholder loan is legal only if certain formalities are in order. If a loan is considered illegal, then the Companies Act stipulates that the loan must be repaid with interest at once. If a legal loan is issued to a shareholder, which is a physical person and not a company, then it will be taxed regardless of it being legal. In reality, it makes not much sense to consider issuing a legal shareholder loan, even when formalities are done correctly concerning the Companies Act. The answer as to why it does not make sense, we will find in the tax rules. Regardless of whether a shareholder loan is considered legal or not concerning the Companies Act, the shareholder will most often be taxed on all shareholder loans unless these are repaid correctly. When a shareholder is a company, then the tax rules relating to shareholder loans do not apply. These types of shareholder loans, in general, will not result in taxation. Only when a shareholder is a physical person, then taxation becomes relevant. In the eyes of the tax authorities, no shareholder loan exists at any point in time, even if there is a shareholder loan according to the Companies Act. The tax office focuses only on the loan payment to the shareholder, which needs to be taxed as either a salary or a dividend. So the tax office does not acknowledge the presence of a loan from a tax perspective. It is the payment to the shareholder that is taxed. So, how should you go about repairing a shareholder loan? A shareholder loan can be often repaired by converting the loan into either a dividend or a salary, but only if the whole process is handled correctly. It is needed to decide on a case-to-case basis what to do. The most important thing to notice here is never repay a shareholder loan. Once the shareholder loan has been repaid without repairing it, then regardless of the loan having been offset with a payment and now showing a zero balance, the shareholder will still be taxed on the loan's original transfer. So the shareholder will have to get an additional salary or dividend to pay the tax on the loan, thus giving a very high tax on the original transfer of the shareholder loan. Therefore, repaying a shareholder loan is a horrible idea, so make sure you consult your accountant first. Now let's talk about repairing a shareholder loan using the payroll method. In general, the reclassification from an illegal shareholder loan to a salary can be done like this. Firstly, a written agreement between the shareholder and the company needs to be drafted, showing that the additional salary, for example a bonus, has been agreed upon. The payment that the shareholder received is considered a gross salary, using the current tax percentage for the shareholder as stated on the personal income tax self-assessment for the month where the loan was received. The gross salary is converted into a net amount. The calculated personal income tax from the converted shareholder loan into salary is then declared together with the gross salary on e-inkomst, which is a part of skatteerverv. Furthermore, the shareholder will need to pay the income tax to the company from his or her private bank account plus interests. At the moment, the interest rate is approximately 10%. You can see the current rates on our website. The company will then pay the income tax to the tax office once shown on skattekonten. The shareholder must transfer the personal income tax and the interest from the private bank account to the company before the tax is due on skattekonten. Otherwise, this amount will be considered a new shareholder loan. The interest that the shareholder pays is considered a taxable income in the company. The shareholder cannot deduct the interest on his or her private tax declaration. If the shareholder loan is discovered after the fiscal year has ended, it has to be shown in the annual report. The personal income tax calculated from the shareholder loan has to be shown as a liability. An explanatory note stating that an illegal loan has occurred in the fiscal year should be added. Now let's talk about repairing a shareholder loan using the dividend method. First of all, the company needs to investigate if the financial report gives the option of distributing a dividend. It will require that the company has reserves available from previous year's profits. Also, it is important that distributing dividends during the first fiscal year is not possible. If it is possible to distribute a dividend, then the shareholder loan is considered a gross dividend. The dividend can be distributed at an ordinary or an extraordinary general meeting. However, it is important that the distribution of the dividend clearly relates to the original transfer to avoid being also taxed on this dividend separately. Some reference to this would therefore be an excellent idea. Always make sure to have an adequate documentation in place. The company will need to declare the gross dividend and a 27% dividend tax. The shareholder will then need to pay the 27% dividend tax to the company from his or her private bank account plus interests. Once the dividend tax is visible as a debt on skattekonten, then the company will pay this to the tax office. What if the shareholder does not have funds to repay the tax to the company? If the shareholder does not have sufficient funds to repay the tax to the company, then either an additional salary or additional dividend can be added during the repaid so that the salary or dividend can contain the total due tax. If it is not possible to do this either, then the management and the shareholder can be reported to the police by the business authority and risk fines or imprisonment later. If you have any questions about repairing shareholder loans or which method is right for you, reach out to us and schedule a consulting call. +45 70 27 2713. You can schedule your online meeting from the front page of our website, daniaaccounting.com. My name is Ida. We are Dania Accounting. Thank you for watching.